Hi, everyone. We are going to be looking at 10. Sorry, let me get my screen share back going on there. Okay. And some of this is, if you read through it, it's going to make a lot of sense as you read through it, hopefully. But I wanted to go over the major concepts and talk about some of the calculations that are presented in this chapter. Will advance. Let's see. There we go. So we're going to calculate the return on an investment, compute the standard deviation of an investment's returns, explain then the connection between historical returns and risks on various types of investments. We're going to describe the importance of the normal distribution and its relationship to investment return. We will contextualize the US market risk premium in global terms. So we're going to look at it with respect to the rest of the world. We're going to look at the impacts on returns during that 2008 financial crisis. And then finally, we'll be differentiating between what we call the arithmetic and geometric average return. So there's our chapter outline. So let's begin with talking about returns. So two major types of returns are dollar and percentage. Now, what's very important to remember is returns are two components. There's what we call current income, which is that direct cash payment from an investment, like interest or dividends in a year. Then we have the other component, which is capital gains or losses. Now, capital gains or losses is how much that security changes value from when you bought it or the beginning of the year to the end of the year. Okay, so, or from the time you bought it to the end of the year, or the day you're looking at. So how much gain or loss would you receive if you sold that investment? And that, of course, would be the selling price minus the cost of the investment. So those two components must be looked at when calculating total return on any investment. So here's our dollar return. Again, if we're looking at stock, it would be the dividend plus or minus the change in the value, the market value. Now your percentage return would be that dollar return divided by that original investment or beginning market value. So again, dollar return would be the dividend plus the change in market value divided by the original investment or market value. The price at times what we would say T. Now that's how you can calculate the percentage return. But remember also, if we break down this formula here, it's really our dividend yield percentage. Remember, that's our dividend in 1 year divided by the price of the stock at some time today. And dividend is in 1 year. Capital gains yield would be the price of the stock in that 1 year minus today's price divided by today's price. So that's what we're really calculating here. Dividend yield plus capital gains yield gives us our total percentage return. Let's take a look. Suppose you bought 100 shares of Walmart, WMT is their symbol, 1 year ago, today at $60. Over the last year, you received $200 in dividends, so that would be $2 a share. At the end of the year, the stock sells for $70. How did you do? So what is your percentage return? And of course, it would be quite well. You invested $6,000, $60 a share times 100 shares. At the end of the year, your stock is worth $7,000. So the dollar capital gain return would be $1,000. During the year, you received dividends of $200. So your dollar income component would be the $200. So you received or have $1,200 of return for a $6,000 original investment. So $1,200 divided by $6,000 is a 20% return on investment. So if we graph this, we spent $6,000. Now, at time 0, and you see this, this is our horizontal axis here. At the end of year 1, so we gave up, oops, sorry, let me go back there. Let me see if I can go back. Give me 1 second. Here we go. Okay, let me go back. Let me reshare that. I'm on my laptop with, here we go, with a crazy mouse. I don't have my normal mouse with me right today. All right, so let's go back to this slide. So if we look at this horizontal axis as our time, at time 0, we spent $6,000. At the end of year 1, we sold the stock for $7,000, resulting in $1,000 in gain, plus we received $200 in dividends. So overall, $1,200 gain, dollar return. So it's just a picture of that formula. Let me see if there's anything else I want to talk about there. So you can also calculate your dividend yield and your capital gains yield and add them together to get that 20%. So before we go to holding period returns, if you jotted this down, remember dividend yield is the dividend during year 1 divided by the original investment. So 200 divided by 6,000. So I'm getting 0.033333. So that's 3.333% into infinity. Then our capital gain yields, the price at the end of year 1, 7,000 minus last year's price, 6,000, $1,000 gain divided by the original investment of 6,000 gives us a 16.666666% return. So add the dividend yield, 3.33333, to the capital gains yield, 16.67, and you get your 20%. Okay, so the next return we want to look at is what's called holding period return. So this is the return that an investor would get when holding an investment over a certain number of years. When the return during the year is a certain amount I, so it is shown as R1. So that's the return value, or RI. So to calculate a holding period return, we would take 1 plus the interest rate at time 1, year 1, times 1 plus the interest rate for time 2, et cetera, et cetera, et cetera. And then after we multiply those all out, subtract 1. So if we look at this through an example, suppose your investment provides the following returns over a 4-year period. So 10% in year 1, minus 5 in year 2, 20% in year 3, and 15% in year 4. We would take 1 plus the return from year 1, so 1.1, multiply that by 1 plus the negative 5%, so that would be 0.95, times 1 plus the 20%, 1.2 times 1 plus the 15%. So you would need to know those returns for those different years. Multiply those all out, you'll get 1.4421, subtract 1. So your return would be 44.21% overall for that 4-year period. So that's the return overall for that 4-year period. So the next part of our discussion looks at these holding period returns. And you can see there it says a famous set of studies dealing with rates of returns on common stock, bonds, and treasury bills was conducted by Robert Ibbotson and Rex Sinquefield. They represent year-by-year historical rates of return starting in 1926 for the following important financial instruments in the US. So large company stocks, which if you look on page 291, the common stock portfolio is based on Standard & Poor's Composites Index for the 500 of the largest stocks in the US. Small company stocks. This is a portfolio to the bottom 5th of stocks traded on the New York Stock Exchange. So they're defining what types of companies are in each group. Long-term corporate bonds. It's a portfolio of high-quality corporate bonds with a 20-year maturity. Long-term US government bonds, based on the US government bonds with a maturity of 20 years. And then US Treasury bills. These are bills with a 1-month maturity. So these are very important financial instruments. They're the 5 most important, probably. So we're going to be looking at the typical types of historical rates of return on these classes of investments. And that's the illustration that was created. So the holding period returns. So what this is saying, this graph, is if you invested $1 back in 1925, 1926 in small company stocks, in 2000, I think that's supposed to be around 2018, it would be worth $32,645.08. If you invested $1 in large company stocks, it would be worth $7,030.31. If you invested it in long-term government bonds, it would be at $141.92. So those are those 20-year maturity. And then if you invested it in the treasury bills, it would be at $21.17. Now, what's $1 worth in terms of today's money? $14.02. That's our inflation line. So you can see the type of growth that has occurred on these, but you can also see the line to get there and how jagged some of them are, like the small company stock. It goes up and down and up and down as it's going up towards that 32,000. Large company stocks has a jag in it, but not as extreme as small company stocks. It doesn't have that bouncing back and forth, extreme bouncing like the small company stocks do. Long-term government bonds, also a lot smoother of an investment than stocks. And those treasury bills, even smoother, meaning there's not a huge amount of jaggedness in the curves over short time periods. So just looking at that picture, you can start formulating some ideas of how these investments really work and what kind of risk is involved in investing in them. Those jagged lines on that small stock, you might get a huge return, but wow, what a ride to get there. Where if you took those treasury bills, a lot smoother. Not a huge return, but that is probably stressful. So the key things about investing life are that investments don't offer their returns on a consistent basis. Some years are higher, some years are lower, and some years are just pure losses. And we saw that in that picture. The way those lines go up and down and up and down. So it didn't matter what investment you had, they all have those kind of years. But historically, over time, over that almost 100-year period, those small company stocks, the most rewarding ones, have the most volatile returns. They're going up and down and all over kind of craziness. And if you want to take a look, on the top of page 293 are the total annual returns of those stocks in a bar graph. And you can see some years are really high, some years low, all over the place. So are large company stocks. But if you flip the page 294, take a look at that US Treasury bills and the long-term government bonds. Some volatility, but not as much. So the least rewarding investments like that Treasury bill have the least volatile returns. So they have more positive returns, if any, negative returns. Where those small company stocks, you had a real lot of highs and a real lot of lows. So again, these are the pictures that are shown here for small company stocks and the US Treasury bills. Look at that comparison. Most volatile versus least. So we could summarize the history of the capital markets by an average return, where R1 to RT are the observed returns, and where T is the time period analyzed. So if you wanted to do a 10-year period, 1975 to 1985, you would use the returns from 1975 to 1985 individually and divide it by 10. So what they did here, though, was for a almost 95-year period, right? 1925 to 2018 almost. And it looks like 17 might be our last year there. Oh no, 2018. And the first year was, looking down at that bottom, 1926. So what they did was they created a graph, a frequency distribution of the yearly returns by years. And you can see the years that have the most returns is around the 10 to 20% return. It's in that range. So we have some outliers like 1931, right? And 1933 and 1954, some really high returns. But the most years have a return somewhere between 10 and 20%. Now we're in large company stocks here, if you notice on the left there. But we can do that for our major types of investments. Small company stocks have a higher average return, but a wider range of variance. We've talked about that. Where large company stocks have a lower average return, but a more narrow array or variance of actual returns. Creating, and all of the returns, by the way, you can calculate. They're given on pages 295 through 297. So you can use those to create any one of these frequency distributions. Now, if you look on page 299, there's the creation, large company, there is a distribution graph of the stocks returns or the bonds returns. So you can see the distribution. So the returns are over a wide range, where if we look at large company stocks, it's a little bit smaller. They have a narrow array or variance of actual returns. So in any given observation period, it's more likely that large company stocks will produce a return near the mean or the average than the small company stocks. And this takes us back into statistics. I hope we had some experience in that. Remember, the mean is your average, basically, where the majority, hover around the majority of your observations. In a small company stock, the variance. So because the returns are all over the place, we're going to have observations farther away from the average or the mean. And that's depicted in the picture on page 299. But in a large company stock, the average, the volatility or variance is not as great. So the returns will be closer to the average than they will for a small company stock. And there they are again. So these are the pictures we want to be looking at. Look at US Treasury bills. There's not much of variance from the average. I mean, everything's in that one little space. So variance is when our returns are farther away. So the larger the farther away they are, the larger the variance. And variance, the square root of the variance, remember, is standard deviation. So a small company's stocks, the standard deviation from the average return could be up to 31.6%. That's one standard deviation. Where large company stocks, that distribution or the variance in terms of standard deviation is 19.8. Take a look at US Treasury bills. The standard deviation from there is 3.1. Not much as compared to other types of investments. So because US government securities have very low volatility or risk, US debt is considered risk-free. So when you buy a government bond or a treasury bill especially because it's such a short maturity time, 1 month, this type of debt is considered risk-free. You are going to receive what you loaned the government back, because if the government doesn't have the money, they will raise taxes to get it. So the government always has a way to get that money to pay you back. So there's no risk in purchasing this kind of investment. So, so again, treasury bills that mature in less than a year even. So they're not even just talking about the ones that just mature in a month, but 1 year or less. The return of such a security is considered risk-free rate. So whatever that rate is, there's no risk involved in it. Now, as you invest in other types of items, now you're adding on a risk component. So you're going to demand a higher return or rate. That is called the risk premium. So the amount of rate or the added return you demand as an investor is called the risk premium. So if your return is 10% and the risk-free rate is 3%, the risk premium is 7%. That's what you want, because you're taking on risk that you may not get your money back that you originally invested. One of the most significant observations of stock market data is this long run excess of stock return. So the return over the risk-free return. So if we average excess return from large company stocks, right now we said large company stocks average return is 11.9%. The US Treasury bill, this is on page 299, is 3.4%. So the risk premium on average for large company stocks is 8.5%. We could do the same calculation for small company stocks and long-term corporate bonds, and we can calculate their average risk premium historically. Suppose that the Wall Street Journal announced that the current rate for a one-year Treasury bill is 2%. Well, that's your risk-free rate, right? What is the expected return on the market of small company stocks? So, given a risk-free rate of 2% and an average historical return on small company stocks of 12.8, that's the risk premium. Now, if you're looking going, well, small company stock is 16.2. That's the overall. Subtract the risk-free premium. So if we take 16.2 minus 3.4, 12.8% is the risk premium associated with small company stocks. Add the 2% current Treasury bill risk-free rate, and you will get the expected return on the market. So on the market of small company stocks. And you could do that with any investment at a current time. So the general rule then, the risk return trade-off, is that the more volatile or riskier return is, the greater the return will be expected to be. Yeah, you're taking on a lot more risk. So you're going to demand a riskier or risk premium that's higher than less volatile or risky investments. So there's no universally agreed upon definition of risk. The measures of risk that we discuss are variance and standard deviation. So remember, variance and standard deviation measure the dispersion of returns from the security's mean. So the standard deviation is our statistical measure of the spread of a sample. Its interpretation is facilitated by a discussion of the normal distribution. Let's take a look. A large enough sample drawn from a normal distribution looks like a bell-shaped curve. It's just the way it will appear. So this is on page 302. And they don't have the wording that's at the bottom of this picture. But let's take a look and make sure you can understand this. So this is taking a look at it looks like the large company stock. So if we go back, let me see. Large company stock, the average return is 11.9%. Standard deviation in both ways is 19.8. So if you take 11.9 plus 19.8, you get 31 point, they have 9%. Let me see if it's around 31.7 though. So at a standard deviation plus 1, and the little symbol there is for standard deviation, that is saying, okay, stocks that have a 31.9% or a year that the return is 31.9% will be in this range. The other way you have to go is take 11.9 minus the standard deviation of 19.8, and you get, I get 7.9, they're coming up with 8.1, but it's close. Now, what does that mean? 2/3, okay? 2/3 of the returns will fall somewhere between the -1 standard deviation and +1 standard deviation. So they will fall within -8.1% to 31.9%. And that's where the 68.26% comes in at. So let me see what else I want to say there. And then if you take a look down lower, a return has a 95.44% chance of falling within the second standard deviation range. And then a return has a 99% chance of falling within a third standard deviation, so plus or minus. So it's just defining and letting you know where returns will fall in a normal distribution. So there's a 66% chance a return in a year will fall within plus or minus 1 of the standard deviation. So somewhere between -8.1% and 31.9%. So it's defining this in our normal distribution. And you can do this for any of the returns. I'm sorry, the investments, large stock, large company stock, small company stock, etc. So what this is telling us, though, is that what the probabilities are that your stock return, your investment's return, will fall in a certain range. And then you have to decide, based on the mean and the standard deviation, if that's a risk or chance you want to take. So if you want to have a 12% return on your investment, there's a 99.74% chance you will. There's also a 68% chance. But if you want a 53% chance, 53%, okay, that's much higher. So we're just telling you the the amount or the probability of returns falling in a certain area. So the return of a large company stock has a standard deviation of 19.8 from 1926 through 2016. If stock returns are normally distributed, the probability that the yearly return will fall within 19.8% of the mean will be approximately 2/3. So how did we calculate this? Well, the way we calculate variance and standard deviation is first determine our variance. So we will take an actual return and subtract it from our average return. Once you have that, now take the square root of that and add it up. So our variance here would be 0.0045 divided by the number of observations, minus 1. So the number of observations minus 1. So we had 4 minus 1. There we go. So our, oh, I'm sorry, that's squared. What I'm sorry, I said that wrong. So if you're going, what do you mean standard deviation, lady? You know, what do you mean square root? So you take the deviation from the mean and you square it for your variance calculation, add them up. As you can see in that last column, then divided by the number of observations minus 1. That will give you your variance. To get your standard deviation, take the square root of the variance. So just a reminder on how we do that type of calculation. So in the past, US stock market risk premium has been substantial. Did US investors earn more as compared to the world? So on page 303, there's information about different markets in the world. And if we do a comparison there to the international market, greater than 50% of tradable stock is not in the US. Isn't that something? So it's all across the rest of the world. Overall, our world average risk premium is just slightly lower than in the US. So the first column on the table on page 303 shows the risk premiums. If we compare that to the US, okay, it's a little bit lower. So when US investors did well, but not dramatically better than investors internationally, because the risk premium is about the same. So again, here is the average risk premium for various countries. It's average about 6.9%. So the average global market risk premium, MRP, is 6.9. The US is from 1900 to 2010 was 7.2%, with a standard deviation of 19.8. Thus, there's a 95% probability that actual MRP is between 3.4% and 11%. So of the 226 financial economists independently estimated MRP at 7%. Okay, so we're all within range. So the US MRP estimate of 7% is reasonable, barring unforeseen changes in risk environment. So you can use that and say, okay, I can take my average risk premium, 7% plus the risk-free rate, and that's what I should be expecting, or that should be what I want as a return. Now, if you want to take on more risk or less risk, you're going to change your return accordingly. So I encourage you to read through the next section. I'm not going to go through it all. I think you can get a lot out of it just reading it, and how 2008 was one of the worst years for stock investors, and how much the Standards & Poor's Index decreased. Of the 500 stocks, 485 were down for the year. 2009 was also a very bad year with a 25.1% decline. And from November 2007 through March of 2009, the S&P lost 56.8% of its value. Now things have turned around dramatically, and the market did gain 65% in 2009, and it's continued to grow. But there's a great graph on page 306 that really depicts the impact of that financial crisis, the housing market crisis, and its effect on the economy, as we know as the Great Recession, and the market. Continuing, there was no economy unscathed, so that's something to keep in mind. It was global. Some securities still performed well. Treasury bonds, high quality corporate bonds, and flight to quality phenomenon. So read about that. Reminder that stocks have significant risk and can under as well as overperform the mean. So what is a great lesson learned from 2008 beyond these things is that we have to be very careful with how we diversify, what type of investments we make. We don't want to put all of our money, all of our investment into one particular type of investment. Because as you can see, stocks can be doing really poor, but treasury bonds can be doing really well. So we want to put and funnel our money in a certain way into various investments so that we still get our overall return desired. And a lot of that is guessing and taking on risk and doing this kind of analysis. Some suggest that our actual market risk premium may actually be higher than 7% right now because of this type of crisis. Okay, so our final part of our chapter deals with, we looked at calculating returns in the beginning of the chapter, but how do we get these average returns? Well, we could do it at arithmetic versus geometric mean. So an arithmetic mean means the return is earned in an average period over multiple periods. The geometric average, the average compound return per period over multiple periods. So now we're in the geometric one, we are looking at compounding, not just an individual return each year. Which is better? The arithmetic average is overly optimistic, but the geometric is overly pessimistic. So we get our two extremes. I should say for long horizons, for the arithmetic, for the geometric, it's bad for short horizons. So here's our geometric average. So we want to take a look and calculate our overall return. It's our holding period return basically, right? So our investors made an average of 9.58%. So we take 1 plus r to the fourth power, basically. So we take 1.10 times 0.95 times 1.2 plus times 1.15, multiply those out, those 4, minus 1, take the square root. Okay, and it looks like the cube have to be on that. Yeah, raise it to the power of IT. Okay. So if you look at the computation in page 307, one second. I just want to make sure computation correctly and I don't steer you wrong. Come on. Sorry about that. Just wanted to make sure I got this calculation right and I wasn't steering you wrong. So if you take 1.10 times 0.95 times 1.20 times 1.15, just do that. I'm following the steps in your book. So you get 1.4421. Raise that to the 1 divided by the time or the number of returns, so 1/4. So I'm going to raise it to the 0.25 power, and you get 1.095844. Subtract 1, and that's your geometric return. So that's saying the investor made an average of 9.58% per year over a holding period return of 44.21%. The geometric average is not the same as the arithmetic average. The arithmetic says just add up all the returns and divide by 4. So for an arithmetic average, it says it's 10%. So you can see the difference between the two calculations. Okay, so you can see the calculations and the difference. Let me see what else I want to say about that. On page 308 is the geometric and the arithmetic averages for each of the investments that were cited in the chapter, large company, small company, et cetera. And you can see where their returns were over that almost 90-year period from 1926 to 2018. as well as the standard deviation, which was already shown to us way back in the beginning of the chapter. So we're just taking a look at the history, the risks, how they're measured, how they're used to determine return. Okay, so hopefully that will help you with your understanding of the chapter and your calculations that are required for the chapter. So post your questions to the discussion board.